A very good evening, ladies and gentlemen. We are back yet with another exciting session on how to evaluate startups. So I welcome you all to this. I am honored to have CA Raghu, the past president of Institute, who comes from Bangalore and who's an authority on startups. This program is being hosted by our Bhiwani branch, and I have CA Sandeep, the chairman, and CA Andy Gupta ji as the vice chairman. I also have the speaker of the day, CA Vinay Bansal, and the moderator of the day, CA Sahil Makkar. So over to Mr. Sahil Makkar for the further proceedings. Sahil, the rise is all yours.
Thank you, Nanda sir. Good evening, everyone, and thank you, Nanda sir, for giving this opportunity to become a moderator for this session. So today's point, like how to evaluate startups. I think in today's era, everyone is looking for like these are startups, and okay, let's have a one startup and we'll get 1 crore rupees. Okay, let's have a startup having a 10 crore rupees. But nobody is aware that how those valuations are arrived, and this is the time like people are getting IPOs and all, dreaming of having startups and all. So I believe this session will actually give some insights to the community and especially CA community to understand how these valuations are happening in these startups and all. Okay, so now I welcome Mr. Sandeep Jangraji, Chairman Bhiwani Branch LLC, for his welcome address and introduction of CA Charanjot Singh Nandaji. Over to you, Sandeep Jangraji.
Thank you, sir. Good evening, everyone, and welcome to the VCM on Management Accounting Insights, How to Evaluate Startups, organized by Committee on Management Accounting of ICAI, hosted by Bhiwani branch of NIRC of ICAI. I, CA Sandeep Jangra, Chairman, Bhiwani branch of NIRC, truly privileged and honored to be amongst all of you. I extend a warm welcome to CA Charanjot Singh Nandaji, Central Council Member for 2019 to 22 of ICAI. Currently, he is Chairman of Committee on Management Accounting of ICAI and Chairman of Internal Audit Standard Board of ICAI. He is Vice Chairman of CPE Committee of ICAI. He is in profession as a practicing chartered accountant since 1991. He is member of board of the 26 various committee of ICAI. He was member, the Central Council member, the ICAI of India 2004 to 2016. He was the member of number of standing and non-standing committee of NIRC of ICAI. He also write a book, a practical guide on audit documentation.
Recording has started.
He also contributed as guest speaker at British Columbia chapter of ICAI on IFRS, effective communication, and forensic audit seminars. I also welcome to all executive members of Bhiwani branch of NIRC and all the members who joined this VCM. I really thankful to host this VCM under Bhiwani branch of NIRC of ICAI. We hope that all the participants who join this VCM will definitely benefit it to all. Thank you very much, sir, and welcome to CA Charanjot Nandaji. Over to you, sir.
Thank you, Sandeep ji. Ladies and gentlemen, today close to 1500 people have joined to attend this seminar. I would like to tell you that our board, the Committee on Management Accounting, is passionately involved in ensuring that we give you best of the seminars. We give you best of the talent to explain the very complex issues in today's life. Chartered accountants today are on crossroads. I remember that the Institute of Chartered Accountants of India was set up by an Act of Parliament way back on 1st July 1949, when the most important document to the democracy, the Constitution, was not adopted. The Constitution to this great country was adopted on 26 January 1950. The pertinent question that arises is, what prompted the Constituent Assembly to set up an Institute of Chartered Accountants of India? The answer is very candid, very simple, very forthcoming. They were looking for a disciplined band of soldiers to steer this country out of confusion. Ladies and gentlemen, we are all today inclined towards creating value and worth in our professional pursuits. And therefore, your committee thought it fit to set up a program on evaluation of startups. And I could find no person better than C.K. Raghu to be the chief guest of this program because he has got deep insights into the startup business, a person who has been consulting startups over the years now, and C.A. Vinay Bansal, who does this day in and day out. And the moderator Sahil Makkad, who's very actively involved in steering the Punjab Angels network, is himself a very ardent, a very prolific speaker on startups. So not taking much of a time, I would call upon all of you to get involved into this webinar and get a call of each and every issue that may be involved. But before this, I want to tell you two very important decisions of the Institute, which were taken on 1st July when the Institute entered into its 73rd year. First, if unfortunately a student loses any of his parents, unfortunately, then his course fees is pardoned. And this shall continue for next 2 years as well. And second important thing, very important, the Ministry of Corporate Affairs came ahead and asked us to set up MDPs, multidisciplinary partnership firms. So now, anyone amongst us, TS, can do partnership with an advocate, we do a partnership with an engineer, can do the partnership with ICAI, CS, architect, MBA, any person who has a regulated entity which regulates the working of that profession. So we are on a larger pedestal now there to steer the entire thing into the right proposition. So not taking much of a time, I would give the dais back to Shri Sahil Makkad because I am as keen to listen to Mr. Raghu, to Mr. Vinay as all of you are. Over to Sahil Makkad ji. Sahil, please unmute yourself. Please unmute yourself.
I'm audible now?
You're now very much.
Yeah. So thank you very much, Nanda sir. And I think I always admire you for your enthusiasm, energy, and passion in you and your speeches and all, and your quotes and all. So I now welcome Mr. K. Raghuji for his special address. And Mr. K. Raghuji is born and brought up in Bangalore, and he has completed his graduation from the prestigious St. Joseph College of Commerce, University of Bangalore. He's a qualified chartered accountant in the year 1990, and he has been elected as the president of Institute of Chartered Accountants of India for the year 2014-15. He's a fellow member of ICAI, and he's an honorary member of Certified Public Accountants of Australia. Mr. K. Raghu is currently holding position as former director on board of Indian Overseas Bank, nominated by the Ministry of Finance as an independent director. Former board of member of the International Federation of Accounts, New York. Member audit committee of the International Federation of Accounts of 2015. Chairman CSR committee of the Institute of Chartered Accountants of India. Mr. K. Raghu, during his tenure as a president for financial year 2015, held various positions at international, national level at boards and committees of various organizations and all. So I welcome you, Raghu sir, for your special address on this topic, and welcome, sir. Over to you.
Welcome, Raghu sir. Welcome.
Thank you.
We are honored. We are blessed by your coming, sir. Great, sir. Please go ahead.
Good evening to all the members watching this webinar. My compliments to the chairman of the committee, Sri Charanjot Singh Nanda, a good friend of mine, for having taken this initiative to conduct a very relevant and interesting webinar on evaluation of startups. Today, startup is a buzzword, and everyone around the country is talking about how startups are shaping the future of business. And considering the fact we are part of the digital revolution currently, startups are disrupting many sectors, and it is absolutely essential for us to know how startups play a very important role in the growth and development of our economy. I wish to compliment Nandaji for having selected this very relevant topic, from your committee, committee and management accounting, for having chosen this topic for the benefit of our members. I am also very happy to meet Mr. Vinay, who is a speaker, guest speaker, who will give us his perspective of how startups are evaluated today, because many of us really do not know the kind of valuations the startups are getting. Many a times when you see the prospectus, when we see that they have declared so much of losses, but they're getting very attractive valuations and they're being listed on the stock exchange with very attractive, very attractive price. I think Vinay will take us through how all this is happening and what is the way forward, and what is it we as chartered accountants, when clients come to us, what is it we need to advise them, and if they are planning to, if they are a startup and they are planning to go for a valuation, how exactly they should go about, and we have a very big role to mentor. I'm happy to know that Sahil is part of Punjab Angels Network, which is also active in the venture capital space, and then Sandeep Jangra, the chairman of the branch, that is he is the chairman of the Bhiwani branch of the Northern India Regional Council, a new branch of the Northern India Regional Council, other office bearers and distinguished friends. Friends, I'm extremely happy to be amongst you this evening to speak on how startups are evaluated. And basically, evaluation would be when I would be speaking, but I'll be giving you a general pitch of the startup scene in the country and how we as chartered accountants can play a very important role, effective role in trying to guide these startups in the right direction. I think we have a very important role to play, because startups, when they have to set up their business entity, definitely they would look for a CA who can help them in guiding the entity which they would like to form. They would like to know how accounts to be maintained. So definitely they play a lot of role, and we as chartered accountants can offer various services to the startups, mentor them and guide them in the right direction. I will take you through a small presentation which I have made on the startup ecosystem in our country. Yeah, this is a brief, you can say, presentation of mine on how startups are evaluated today. And here, one thing I would like to make it very clear to all the chartered accountants, viewing this particular webinar, is that startups today have gained momentum. Today, more than 41,061 startups as of 23rd December 2020 has been recognized by the government according to the economic survey. And India is today the third largest destination for startups. And considering the fact that India is growing very fast, purchasing power of the people is increasing every year, we see there's a tremendous potential for the startups. And of course, we have the the benefit of a huge diversity in culture, language, ethnicity, religion, and this is the right what you can say. Situation for startups to grow in our country, and the government is also supporting startups, and the government is very keen that more and more startups should start doing business in our country. The government has been, as I said, very bullish. The government has taken various measures to support startups. They've started, they've defined what a startup is. They've simplified regulations. They're providing income tax exemptions and funds for startups, and many banks have started supporting and startups. SIDBI is a good example, and the government has also set up the Startup India Seed Fund Scheme with a corpus of 945 crores to provide financial assistance to startups for proof of concept, prototype development, product trials, market entry, and commercialization. This is a real good positive step the government has taken. And Startup Yatra initiative by Startup India in 2017 to search for entrepreneurial talent in Tier 2 and Tier 3 cities has been a success. It has been conducted in 207 districts across 23 states, impacting 78,346 aspiring entrepreneurs, and almost 1,424 incubation officers have been given to the startups. So this is something very good. The government has been very bullish, and they have been supporting startups in a very big way. Coming to evaluation of startup, why startups need to be evaluated? Yes, entrepreneurs would like to know what is the value of their startup. They would have put in a lot of money. They would have bootstrapped their entity. They would have invested all their lifelong savings. They would have borrowed money from their parents. They borrowed money from their relatives. They borrowed money from their friends. And after having bootstrapped and having worked, having quit cozy jobs and getting into setting up a startup, they would be spending a lot of time and energy to build the concept, business model. So let us say once the business, the product is ready or the service is ready, they would want evaluation. They want the startup to be evaluated so that they could disinvest a portion of their investment and have venture capital funds to invest or high net worth individuals to invest. And today in countries like US, crowdfunding is also very popular. No doubt in India, crowdfunding is still not a reality. But yes, there's a need for entrepreneurs to know what is the value of the enterprises. Investors like me, if at all I want to know what is the value of Paytm or Zomato, yes, I would like to know how the company is valued, what is the valuation. Bankers, today a lot of banks are supporting startups. They're giving line of credits. I've been on the board of Indian Overseas Bank as a independent director for 3 years. I know how exactly we go about looking at startups. We're very cautious. We tread a very safe path. And we just don't go by the valuations given. We have our own methodologies to evaluate startup. But yes, we have our own evaluation mechanism to lend to startups. Venture capitalists, I think our speaker today would throw more light, Vinay, as to how venture capitalists would look at startups, because they also need to value the startups. Seed fund managers. So each of the stakeholder has different ways of evaluating a startup. And as a result of which startups have become, evaluating startups have become very, very important. Today, we have seen a lot of successful startups in our country. I would not go into the details, but some of them have, seen tremendous valuations and they've achieved the unicorn status. Paytm, as you know, is ranked 9th in the world ranking with a valuation of $16 billion. It is the only startup to make it to the top 10. And I'm sure even if you buy a tender coconut in any of the roadsides or you go and eat a samosa, the vendor is ready to accept your, swipe your thing on the Paytm. You can pay through Paytm. Paytm has become very popular. And even in a city like Bangalore, I find Paytm in almost all the vegetable vendors, fruit vendors. You find all the roadside vendors also using Paytm extensively. Today, the valuation is phenomenal, and companies like Paytm has been extremely successful. Then if you look at Byju's, the educational sector, thanks to COVID, has undergone a huge, you can say, change, and the entire education sector has been disrupted. Today, gone are the days. Now we have hybrid learning where students, whether it's the primary or middle school or high school or even professional courses, people have switched over to online reading. Even CA students who used to go to many big cities for CA coaching, today they're able to download the lectures of the top speakers of the country. They can choose a good teacher who teaches auditing in Delhi, a teacher who can teach costing from Bangalore. They can pick and choose teachers. So the entire concept of tutoring has undergone a change, coaching has undergone a change. Byju has led this, you can say, the revolution of online training, and almost 9 lakh people are their subscribers today. And they have a lot of funds supporting them. And I can only say that, again, 11.7 billion, and they're looking at for a fresh round of funding. When we say $11.7 billion, we really wonder how the valuation take place, how exactly. I'm sure our speaker will throw more light on it. Ola, again, been a big success. Today, you have housewives pulling out their mobile phone and ordering for a Ola auto or a Ola cab. And today, they are coming out with Ola scooters, and they're setting up a new facility for it. And the valuation of this company is also, mind-blowing. It was priced at about $6.5 billion in 19 itself. I'm sure today Ola valuation is extremely good. Zomato, all of us have seen the public offering recently, how it was valued, what was the share price, what it was quoted, and still when they've declared losses for the last few years, and the promoters have very clearly said they'll not have profit the next few years. There was a great frenzy for people to invest in Zomato, and we have seen the success story of the Zomato IPO. Then again, we have Oyo Rooms, Zerodha, Big Basket, Dream11, Swiggy, Freshworks, Udaan, Paytm Man. All these are success stories. So what I'm trying to tell you, friends, is that today we have a lot of successful startup ventures in our country. Investors are ready to invest money in them, and they are ready to sort of take that risk of investing in these startups, because they find that these startups can do well, and they're able to provide employment to a lot of people. They're able to, even startups like Dunzo during COVID, it was a big success. Even though Dunzo was popular even before COVID, COVID helped people to carry send goods to their relatives' houses, friends' houses using Dunzo. Dunzo became so popular during the COVID times. So what I mean to say today, startups would be the would be in a very growth phase. And as chartered accountants, my message to all the participants in this webinar is that we have a very important role to play, because most of the startups are formed by engineers and entrepreneurs who do not have the knowledge of accounting, finance, law, and that is where we can be helpful. And generally, chartered accountants are known as trusted advisors. So, startups would come to you for formation of a legal entity. You should advise them whether to go for a private limited company, whether to go for a LLP, whether to go for a partnership firm, or how they should set up their entity. We should also guide them on how they should go about registering the company, all the various compliances are associated with them. Once we talk to them and explain to them, we should be in a position to guide them as to what should be their capital, share capital, how they should structure the funding. We should help them in preparing the business plan. All this is very, very important. And then registration under various laws they are not aware, under the ESI, TF, then shops and establishments, GST, income tax, all this registration. I think it is our responsibility to guide them when they come to you, because they can't afford a full-fledged finance team, they can't afford a CFO. So when they come to you for guidance, I think you should provide end-to-end services to the startups. Compliances like GST return filing, TDS return filing, income tax return filing for startups is something we can do on an ongoing basis. We can also help them in preparation of their project reports, and then design their controls in the organization. You can also help them in designing the business plan, and even the regular accounting can be handled by you. So we find a lot of chartered accountants across the country are supporting startups in all these traditional areas. But I'm sure Vinay would guide us as to how chartered accountants can play a role in mentoring the startups, so that they're able to get a good valuation, they're able to reach out to the market, and encash their what you can say, they're able to disinvest their equity so that they can grow bigger. I think, friends, these are some of the things which I would like to wanted to share with you. Startups are here to stay. I have come from a city like Bangalore. Bangalore has been a big success story for startups. We have many successful startups. Even Zerodha, which is an online trading platform for shares, is such a big success today. A lot of young professionals are keen to trade on the stock exchange, futures, options, equity, debt funds. So Zerodha has been so successful. Many of the successful startups are from Bangalore, and I'm seeing a lot of chartered accountants are involved in the valuation space, valuation of startups. They're involved in guiding the startups, helping them in accounting, helping them in structuring their financial transactions, helping them in various ways. So I see a big opportunity for each one of us watching this webinar in supporting startups. Let us say you're able to support 10 to 15 startups in a year. I'm sure that will be a great contribution to them, to the startup ecosystem. And maybe one can become a Paytm or a Zomato or a Ola. I don't think you'll be surprised that one of your clients becomes a unicorn. So with this background, I'm sure the speaker would take us through the various, you can say, tricky things that are there in valuation, how exactly valuation happens, what are the pitfalls, and what is the guidance that we need to give to mentors. I wish good luck to you, and I would like to thank Nandaji, the chairman of this committee, for having given me an opportunity to be amongst you this evening. Good luck to each one of you, all the participants. Thank you very much.
Thank you, Raghu sir, for your wonderful deliberation, and you have really set the context right. And now I'll for introduction of Mr. Vinay Bansalji, who is the speaker for today's session. CA Vinay Bansalji is a founder and CEO of Inflection Point Ventures. He is qualified member ICAI, ICSI, and ICWA. He's all the three companies secretary and past 20 plus years of global experience in Fortune 50 companies, startups, investments, he's a turnaround specialist in operations for TPG portfolios. He has a hands-on startup experience and entrepreneurship as CFO and CIO. He has played global roles across US, UK, Singapore, Thailand, China. Last role as a CFO for supply chain South Asia with $1.3 billion in operations. He has played multiple roles in manufacturing, finance, supply chain, and sourcing. So now I request Vinay Bansalji for his deliberation, and thank you. Over to you, sir. Vinay sir.
Thank you, Vinayji. Thank you so much, and I want to thank our Honorable Past President, Mr. Raghu, for a very scintillating and mind-boggling presentation, sir. All were given through the sets to listen to the word of wisdom and put at rest all the doubts that may have arisen during the course of their professional pursuits. So, ladies and gentlemen, let us listen to Vinayji, who has a deep experience and insight into the startups, and that would ultimately take us to a parlance where we start understanding how we can venture to newer pastures of practice. Thank you. Thank you so much. Over to Vinayji. Vinayji, please unmute yourself. Please unmute yourself.
Vinayji, you are not audible right now.
Vinayji, you are not audible. Unmute करें साहब. आपका system mute unmute करें.
Not audible till now.
I think some.
Now,
Yes, sir, you are audible. Please carry on. You are audible.
Okay. I think somebody will need to open up my video also. I'm not able to open the video. I think it's controlled at the back end. But till that video comes up, I just wanted to say a big thank you, Nandaji, for having me here with this esteemed audience. And also thank you to Raghu and Sahil for being here and moderating the session as well. So if I can share my screen and start, let me know if you are able to see my screen. So Sahil, let me know if you are able to see. Or you may have to allow the host at the back.
as soon as it is visible.
You are the host now, Mr. Vinay? You are the host? आप देखिए host में anyway.
Okay, let me see. Where do I?
Sir, जो नीचे you come on the third slot where there are three dots there. नीचे देखिए सर, close button के साथ screen के बिल्कुल नीचे उसको दबाएं तो लिखा था ना share.
Yeah,
क्या screen आ रहा है?
I can see a share screen. I am pressing it.
आप उसको press करें.
नहीं, वो ले नहीं रहा है.
I think he need to be made host.
Neither am I able to. Or should I log in again?
Please log in again. Please log in again.
Let me log out.
Till the time Vinayji is logging, I would request other participants also to ask questions in a chat box and all so that we can take them up at the end.
And Sahilji, by the time he's logging, you are also an expert on startup, so you can give a few insights of your journey so that people are induced and keep glued to the sets.
Yeah. So I'm audible right now? Yeah. Hello.
Okay, hopefully I am audible and visible now.
Yeah, Vinayji.
Can you hear me?
I can hear you, but I think your screen and your video is not moving.
Okay. Let me start my. Is my screen visible now?
Yeah, now it is visible.
Great,
Okay.
sir. You're audible. You're visible now. Please go ahead.
All right, sir. Thank you. I have a few questions for the audience also. Is there a way I can get the answer, Sahil? Is there a chat window somewhere?
Yeah, I'll at the end I'll take your question. I have opened the chat window and I'll ask questions at the end of your presentation.
Okay. No, there are some questions built into the presentation also for engagement with the audience. So, but that's fine. If it doesn't work, then it doesn't work.
Okay.
But if there is, then I could see some answers on the chat window.
So maybe I'll
Okay.
let you know. Yeah. So your video is not moving. I think it's a video is still. So maybe your screen has been stopped. Your presentation and your voice is coming. Your presentation is visible. Your voice is coming.
Is the presentation moving at least?
Yeah. Your presentation is moving.
Okay, so I don't know why the video is not, because I can very clearly see my video here. But anyway, my video is not that important, so we'll just get started.
Yeah.
So as we were, as I was listening to Raghu sir, he made some very good points around how do we work with startups, what is there for chartered accountants to gain, and work with startups, help them, and also in the process, engage in their professional pursuit while working with startups. So I think I'll try to cover that as well. Startup investing and startup evaluation is a long course. It's not a 1 hour or a 2 hour course. And therefore, to able to go deep on a course, I wanted to cover the basics and the why of startups today. And, over the next few sessions, we can cover more as we go along. But I'll still be happy to answer any questions that come today after I finish about, an hour worth of the presentation. So before I start, I was just talking to Raghu sir, and he said, the moment he has moved back from Delhi to Bangalore, he's missing the samosas. Delhi samosas back in Bangalore. So, that is if that statement is heard by a founder, a great founder, that is the spark of an idea. If he thinks that Raghu sir cannot get samosas in Bangalore, that's a problem Raghu sir is facing that he never faced in Delhi. So a good founder will take that problem statement, start a samosa company in Bangalore, which makes great samosas and makes Raghu sir forget Delhi. Right. So that's exactly what a samosa party does, which is what we invested in a few days back, a few months back, and now provides great samosas in Bangalore as well. Right. So that's how founders think. They take problems, solve them, and then solve them at scale. Now, I wanted to engage the audience in the mindset of a founder, right? People ask us, how do you value a startup? How do you value everything that you've got? So that here is a question for the audience. So let's say you are in a room, which is, let's say today, a blue jeans room, and I was to give $5 to each one of you and say that you have 2 hours to make as much money with this $5, and come back after 2 hours, and I will give you a 3-minute presentation slot and present your idea to this group of chartered accountants, which is the best group of NIRC with more than 1,000 participants. What will you go about doing in those 2 hours with that $5? Any ideas? I don't know if people can share it on the chat window. They can share their thoughts on the chat window. Or if they can speak up, that's fine too. Or if not, we'll just give 30 seconds to 1 minute for everyone to think through their idea.
So I'll let you know if there is any question on chat window or any responses on chat window.
Thank you, Sahil. So let's see how many entrepreneurs do we have within Chartered Accountants community.
No response till now, so I think you can go ahead.
All right. So this is what most people do with $5. They will start a car wash place for 2 hours, or they will put up a Nimbu Pani stand and sell, Nimbu Pani, because in $5 all you'll get is lemons and water, right? And some sugar. Some others will buy a lottery ticket. They will gamble, and others will directly go to a casino and put $5 on the roulette table to see if that 5 becomes 50, right? Now, this is how most people think about multiplying their money. But that's not how the founders think. The way the founders will think is very differently. For them, the resource is not just $5. The resources are $5 plus the 2 hours time that they've got, plus another 3 minutes that they've got, right? So some of the teams will go and book the restaurants, and then give it out to somebody with who wants to jump the queue. Other people may also want to serve something else and use their energy and their ability to solve problems for others. But the best teams use all the three resources. They realize that the most powerful resource is the last 2 minutes. And many people will be willing to actually pay more money for that 2-minute slot in front of a Stanford class to hire students from there. And they make $650 just by selling that 3-minute slot. And on top, they will also use the 2 hours to, do a restaurant booking. Plus they will use the $5 also to make the most out of all the time, ability, and the money that's available to them. And that's what makes evaluation and valuation of the startups very, very difficult. And that's where these valuations start to soar. Having said that, let us think about what can we as chartered accountants gain or learn from startups. As chartered accountants, we have a huge opportunity to grow professionally by associating with this startup ecosystem. For example, if let's say you were the chartered accountant advising Dipinder Goyal of Zomato 10 years back, and he likes your work, will you not be the firm working with Zomato, the unicorn, and an IPO today, right? So once you associate with startups who have an hyper growth, it also makes your growth hyper. It's like sitting in a rocket that's, going at speed of 2 or 3 Mach into the space, you go with it, right? So that's one thing we can do as chartered accountants with the startups. Second is growing our knowledge base. Sometimes we get, very, very, very linked into the tax practice that we do, or, the statutory accounts that we do, internal audit that we do, the compliances that we do, the income tax that we do. But how about looking at it end to end as a business? So when you work with founders, when you work with investors, you look from a business from an idea to an execution or to an IPO. And that's what makes you learn far more than what you could do otherwise in a large business, where the transactions are very heavy and you can only focus on one small silo. Third is you can grow your business as a chartered accountant, right? The startups can be your customers and they come in thousands. We see about 8,000 to 9,000 startups every year. Next, very important is to grow your network. We can't advertise as chartered accountant, but when you are sitting with the startups and with the investors, you will know very large number of investors, very large number of people who will use services of chartered accountants. In fact, large firms globally like KPMG or EY, etc., work very closely with angel firms, with VCs, with startups to work with them and grow with them over a period of time. And also along the way, learn from a diverse set of people, not just accountants. Next, you will learn how to run a business, not just how to audit a business, how to advise a business. So when you are on the board, helping with your ideas, helping with your expertise in accounting or taxation, you will also know how to do marketing and sales, how to, how are the businesses run, and bring a more holistic approach to the startup. And as Raghu sir mentioned, you can grow your country. Startups provide the best level of jobs in the country. The most enriching and the most learning jobs in the country come from startups. And of course, what you will know and realize is innovation comes from startups. And when we work for our own thing, we work 24/7 versus working for somebody else where we may work only 8 hours a day. So the learning in 24/7 is far more enriching than working for somebody else. And last but not the least, wealth is another important aspect that you can grow. And we'll talk through this aspect a little bit in more detail as to how people can grow their wealth by working with the startups. Zomato, Paytm, Ola are the examples that Raghu sir took. There are many more that happen along these lines. Now, why should we be very interested in startups, right? Raghu sir gave a lot of good statistics. Let me add a few more. Today, India has 86.7% tele-density, means 90% of the population has access to mobile phones. 67 to 70 crore population, more than 50% of population has broadband connection today or a smartphone today to be able to connect, do e-commerce, order groceries, order Myntra, do stuff, make phone calls, watch geo videos, and so on and so forth. So that is a big change that has happened, just in front of our eyes in the last 10 to 15 years. Think 2007, only 4 crore internet users. Today, 62 crore, 15 times in 15 years. When I was doing my CA, I only had access to a dial-up internet connection. Today, an average household uses 10 GB per month of data. My household uses about 500 GB a year, 500 GB a month. Now that's a huge thing which could not have been imagined earlier. Number of digital payments were only 5 crore, including industry 10 years back. Today, $2 billion are paid annually in this country, more. With the invent of Bharat Pay, Google Pay, Bheem, UPI, it's exploded. VC dollars come in billions of dollars today, tens of billions of dollars in the country today. So 10 years have changed things. Have we changed as chartered accountants in our practice in the last 10 years? Number of startups every year is about 9 to 10,000 in this country, and will create about 50 lakhs jobs every year by 2025. Think about India. We have grown up saying, go educate yourself, otherwise you will not be able to earn well. And today, Baiju as an edtech startup is the highest valued edtech startup in the world. And that is our obsession with education. Our fintech startups are best globally. They are most advanced. Raghu sir talked about Paytm. Things like Paytm, Bharat Pay, or PhonePe, these companies are cutting edge. If you go to US, you will not find companies even closer to what they are doing. Agri reforms. Companies are doing a lot of work on agricultural supply chain and making sure the fresh supply from the farmer comes to your home in 16 hours. OTP, Milk Basket, Big Basket, Grofers, a lot of these companies are doing top-notch work which is happening the best in India globally. And something to open our eyes as to why we should be opening our eyes and looking at this big thing that's happening right next to us. In terms of government and regulation, huge amount of things have changed. Again, Raghu sir alluded to it. A lot of liquidity is there. Government is pro startups, understands that a lot of angel investors need to be able to put money here. It's a new asset class that has emerged in the last 5 to 6 years only, right? VC investments are one of the highest globally in India. Deal sizes are growing, and people like you and me have a huge opportunity to make money. Let me post a simple question to this audience. If you were given a chance in putting the money in Zomato 10 years back, it started in 2010. Would you want to put money in Zomato? Yes or no on the chat windows. In 2010. This is just a 10-year-old company. Sahil, do we have any answers on the chat window?
So I'm waiting for another few seconds because previously there were few responses, but it displayed later.
Okay,
I think
no
this
problem.
chat shows later, shows questions little bit late.
Sure.
Like for previous, I'll just in the meantime share the previous people responded for that question is take $5 from everyone and invest. and some said I'll do share trading, and some told that we'll pool funds and start a mini restaurant and all. That was the replies for your previous question and all.
Thank you, Sahil. So these were very similar to the page I presented, right? But nobody
Yeah.
thought about using 3 minutes to present to a large audience, right? And make large amount there. And that's how startup mindset is very different from a traditional mindset. We find new areas where others don't find and others don't see.
Mm-hmm.
All right. So how many people want to invest in Zomato 10 years back?
So they have probably no. One answer is yes, then one is yes, I would like to invest, and maybe no, as it is a loss making. So these are
Yeah.
the right now.
Sure. If you had invested 10 years back, today you could have sold those shares in the IPO, right? But would you like to invest today after the IPO? Most people will say no, it's very expensive, right? For those it was expensive 10 years back, it's more expensive today. What that tells us is that today most of the returns are made in private equity markets. When the company is still private, not after it goes public, right? And that is where angel investing or looking at startups or investing in startups gives you that edge to be able to look at the company when it is still private and there's a lot of value to be created in startups. So let's take an example here. Give me an answer as to how many times do you think Peter Thiel made his money from his investment in Facebook when the company went public?
Participants, respond in your chat box, and we can discuss this.
Sure. So I'll come back to this later when Sahil has answered, so I'll not release the suspense, right? But let's look at the various asset classes that are available to all of us. We are chartered accountants. We advise our clients on the asset classes. Sir, आप सुकन्या समृद्धि में अपने daughter के लिए डाल दीजिए. Sir, please invest in PPF, etc. These are great asset classes. To me, personally, Sukanya Samriddhi, PPF are the best asset classes over a period of time. But the problem is they're only per year, right? So what do you do if you have more money? Would you go to gold? Would you go to fixed deposits? Would you go to listed equities? Gold between 2012 to 2019 went nowhere, 7 years. Similarly, today, if you put money in fixed deposits, you will get interest rate of 5%. Take the tax rates out, 3%. That is the return, which is far lower than your inflation. Equities, even today, long-term capital gains are taxable, till 12%. Real estate, by the way, is the largest amount of money blocked in real estate in this country. I can almost bet and guarantee that 80% of the people in this room, your 80% of the wealth is still locked up in real estate. And by the way, real estate has not gone anywhere between 2012 and 2020. Right? Only a few pockets of the country where real estate have grown. So, question is, where are the returns? The returns are where there is productive work happening. Returns are where people are using their money of $5 with their brains, with their time, combining it all and giving you a fantastic return. And that happens in startups or private companies which are working 24/7 to make a big difference in the work that they do and in making a big difference in the quality of life, the quality of work, the quality of jobs, and the quality of people we create in this country. So a huge time to open up our eyes and minds to see what is happening outside. Are we investing it in the best place? Right? Catching them young is important. As you see on the right-hand side, 90% of the gain is made by the time the companies are going public today. This was not the case when my father used to invest in public companies or IPOs. That time there was no book buildings. A IPO will list, it will go 10x, 20x, right? And the public companies will continue to grow. Now with private capital available, this is no longer the case. So Sahil, let me know when those answers come in. We'll come back.
So few answers have come up. 3 have mentioned C option, 1 has mentioned B option, and 1 has mentioned D option.
So I think all of you get the context. What number of times? So Peter Thiel made 2000 times return. What that means, if you invested 10 lakh rupees in Facebook, when it went IPO within 5 to 7 years, you made 20 crore rupees. Now, even if you invested in 10 Facebooks and you invested 1 crore, 9 went bad, till you made 20 crores out of 1 crore, right? That is the kind of work that happens in startups. So something to think about deeply. How is India doing? India, you started about 2005, 2010 timeframe, companies like Flipkart, etc. starting to come in. They took about 5 to 6 years to become a unicorn. Then companies started becoming unicorns much faster. Swiggy, Rivigo took about 4 years. By the way, unicorn is a company which is valued at $1 billion or above, or in today's Indian market cap, 7,500 crore or above, right? Then companies started becoming that valued in 2 years. Udaan and Ola made it. I cut a check to BharatPay in 2018, and today is more than $1 billion. We cut the first check to BharatPay personally, right? And today it is one of the India's best known fintech companies, all in 3 years, right? So that's the speed at which India is growing. We think the reports suggest that there will be about 100 unicorns in India by 2025. But you would be shocked to hear within 2021, in the first 5 months, 20 plus unicorns were born. So we believe that by 2025, it will be far above 200 now, not just 100. Question is, are you a part of this journey or are you not? Right? On the left hand side, you see the number of times the returns have gotten by the Indian startups. And all of us had a chance, if we had our eyes and ears open, to be invested. Even in the developed countries like UK and US, the IRRs are 26% to 22%. This is proved on the bottom right side of the page. Now let me just rekindle your mind a little bit. We as chartered accountants understand IRR very well. So the difference in an FD, 5%. If you invest 10 lakh rupees in an FD today at 5.5%, in 10 years, that will be about 18 lakh rupees. If you invest the same 10 lakhs in a startup which is giving you a 26% IRR, that 10 lakhs will become 1 crore rupees. So that's the difference between an FD rate of interest and investing in startups, or difference between a 5 to 6% IRR to a 26% IRR, right? So that is the magnitude difference you can make to your wealth as an alternative asset class. Now, how should you invest? It is by investing with groups, with people like Sahil, who come together with another group of people, where you have a chance to go deeper. You look at sourcing, you know the startup, you know the founder, you look at the legal documentation, you look at the business due diligence, and you can negotiate far better terms to be able to be on the board seat, for example. Individually, none of us can do that because the business has to be looked end to end. So organized angel groups can make far better decisions collectively rather than trying to work with the startup individually. Individually, you cannot give a large check to a startup, which may be important for the startup in its early stages. But small checks may not help your startup grow to the scale it needs to be. How can you grow professionally? Young entrepreneurs that don't have much experience, they don't know how to set up a company. How should be the capital structure? How should be the equity? How should they look at the P&L? How should they look at the cash flow? Where should they get the money from? Accountants can help them get there, and they will highly value your advice. They'll respect you as professionals, and they're willing to work with you and also give you a part of their wealth early on as they go. They need subject matter expertise. They need guidance. They need connections. They need to hire people. All of us can help them do a lot more while learning and growing with them. Now, the problem still is 90% of the startups fail. Right? That is all we hear. And here is how TB Insights did their research. They said these are the reasons why startups fail. So startups fail, in our parlance, we club these areas into 3 broad buckets. The first bucket is the business quality, which is how do you evaluate a business, whether it is a good business or not. Second, the second largest bucket of failure was founding team, right? If people are not right, people don't bring the right skill set, they don't gel with each other, they can't work with each other, they tend to fail. So 70 to 80% of the failures come within these two buckets. And last is, for lack of funding, very few startups fail. So that is where we developed our approach of evaluating great businesses, then evaluating great founders, and then only looking at the funding part, right? So as I was talking about samosas to Raghu sir said there was another company that started samosas in Bangalore, but the quality wasn't good, so it failed, right? So that is where a business quality is very important, and we should be able to look at a business holistically from various angles. When I evaluate a startup, I evaluate it from 100 points, different points to look at where it could fail. Then we look at founders from another 100 vantage points before we say, okay, the founding team is good. So today I'll spend a little bit more time on business quality because we will not have the whole 10 hours that I usually take to explain how we look at the three buckets of funding, of looking at or evaluating startups. Now, how do we evaluate startups? I would want to start with a very interesting quote by Warren Buffett, one of the best investors globally. When a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. Which means even if we put the best of the people into a business that is known, or into an industry which is known for bad economics, the best of the people cannot take it out. Because the bad economics will remain bad economics. Right? The economics of a milk business will remain the economics of a milk business. You cannot change that unless you disrupt the whole business. Right? And therefore, the best of the people will be only able to give you that much gross margins only. But the best of the people looking at disruptive businesses can change the whole paradigm for you. Right? So at IPV, we use the Porter's 5 forces very closely, and we look at these 7 tests in evaluating a business. Which means, is the product required by the market? Or is the product ahead of its time? You know, a lot of people started video on internet or news on internet 20 years back. But it was not successful. They failed. Why? Because internet was not fast enough to even transmit video. Internet was not fast enough to transmit radio. Today we can even transmit live video between you and me over a Zoom call. That was not possible 20 years back. 20 years back you cannot use navigation because there was no Google Maps. Today you can do navigation effortlessly, you don't even need to remember anything. 20 years back we remembered phone numbers of every friend. Today we don't even remember the phone number of our father or our son. Things are changing because technology has changed. The products need to be timed well and they need to be the need of the market. Second most important thing to test is, are the customers there? Or are we ignoring the customers what they are saying? Most businesses, most founders fail here. They don't listen to the customer empathetically. They have a solution, they have a technology, they want to force it upon the customers. That's not how it should work. We should understand the problem of our customer, then come back and find the right technology to solve, and then solve for the delight of the customer. Unfriendly product. A lot of the companies brought smartphones before Apple. They had screens, everything was there, but they could never use it because it was not usable. So if the product is not having a good product market fit with the consumer, it will not work. Competition, another very important area. If you are entering a place where there's already a lot of competition, it's not going to succeed. If you're trying to put a laundry in place, a laundromat in place as a business, you are competing with the maids, the cheap maids in India, right? US it will succeed, India it will not succeed, at least today. Till the maid prices go up so much, or during pandemic when maids were not available, those businesses could succeed, right? So look at the competition from all angles. Relevant business model, which means, are you gonna give 10 rupees in earning a 1 rupee of revenue? They are wrong business models. They will run out one day or the other. It's important to know the business model right, and it should be relevant. Costing and pricing issues. Many founders fail here. They don't price their product well, or they don't understand the cost of their product, which as accountants, we know what is the marginal costing. We don't apply that. And by the way, the chartered accountant community, the practicing accountants, the management accountants here can add a lot of value to the startups in managing the cost and pricing issues very, very sharply. It can be a difference between life and death of a startup. And last point that we look at is ability to scale. Is that business scalable? If Dr. Raghu does not get samosas in Bangalore, I am sure there are a lot of many such people who don't get samosas, good samosas in Bangalore. That is the size of the market that it can go to and geographically expand. Last but not the least, legal challenges are very critical. For example, 2 years back, telemedicine was not legal in the country. Doctors will not be allowed to do teleconsultations. But come Corona, the law has changed. 5 years back, tele-prescription was not allowed. You could not ask legally a chemist to deliver medicines at your house by just giving an electronic prescription. Today, the law has changed under Corona. Now, companies like PharmEasy, NetMeds, etc. are gaining huge valuations. So, legal angle has to be very clearly seen before we evaluate a business and go deeper here. So, folks, please keep sending your questions to Sahil on the chat window. And Sahil, please feel free to stop me at any point in time when you have questions, and I'll be happy to answer there. In the meantime, I'll continue to move.
So there are a few questions, but I think we'll take all the questions in end so that you can finish up your presentation.
Sure. Now, what do you look at while looking at a business? Questions to ask. Is the product there? Do the customers want the product? Is it scalable? Are there enough customers? What is that competitive moat that this business has? What is it that nobody else can break? What are the benefits that it will continue to have in the future? Is the business model shorter sales cycle, longer sales cycle? Are you creating a large value proposition? Will you get a recurring revenue? The subscription model versus pay-as-you-go model. Traction, are you seeing a huge growth? So when Netflix started, within 1 day their servers crashed. The demand was so much, right? Are you going to see that kind of a demand? Are you engaging with your customers? Are you retaining your customers, right? Very important to have a good cohort of customer retention. Are your burn too much? Are you using the funds properly? Are you diluting yourself too much? How are the valuations? Who are the current investors or the partners you are working with? What is the kind of demand you have? What are the previous rounds? What is the skin of the founder in the game? A lot of things to be looked at when you're focusing on the business. So hopefully that gives you a little bit of flavor of how to look at businesses. There's a whole lot, much larger class that I do. Anybody who wants to get that class, please, you can reach out through Sahil or Dr. Nanda, and we'll be happy to give you more detail. And a lot of the professionals tell us today that they are growing their knowledge base with working with startups and angel groups. The question is the chartered accountant community and communities around you leveraging that knowledge and the ability to learn, growing your knowledge base and become the best in the accounting that you are, right? So here is my question number 2 for the audience. Which is that founder who, when started off, had to do 60 meetings to raise its first $1 million? Some investors even asked him, what is the internet? So folks, please feel free to answer on the chat window, and I'll come back to this question in a minute from now once Sahil has a few answers from the audience.
Yeah.
All right. Now, how can you grow your business? Number 1, you can get access to early solutions. Remember when LinkedIn started? Remember when the Google Mail started? Only a few selected people got access. So if you are an investor in a great startup, you will get the first access. Second, startups have hunger in their stomach. They have fire in their belly. When they build a product and you are a customer, you ask for customization, they'll do it for you. Tally will still do customizations. Microsoft may not be able to do those customizations for a small business, right? So if you're working with startups, you may get the best product from them and to your own needs. Number 3, you can achieve lower cost and generate higher business for yourself. Startups burn cash, which means they're not profitable, which means they're giving or leaving more value at the table for their customers, or they want more customers to come, and therefore they'll drop prices. So you can make the benefit of that. Startups can be your vendors, they can be your customers. Think about it. You can serve the startups. At the same time, startups like Tally or other software solutions like Freshworks, you can leverage them to make your business better. And access to latest technology firsthand only to you. You can go and brag about with your kids, family, friends, and others, right? Something to think about in growing your business along with your startups. And of course, growing your business acumen as well. You will learn holistically, you will solve real life problems, you will have the opportunity to become a board member, and you can get to see how business critical decisions translate on the ground. How does the rubber meet the road? So something for you to think about. And last but not the least, my most favorite one is startups can help you stay younger. Even if you are a 55-year-old or a 60-year-old chartered accountant in practice, by working with young people, you will stay younger. And you may say, Vinay, this is just a joke. I have a proof. And here is the proof in front of you, in front of your eyes on the screen. All of these investors lived far longer than their peers. Today, Warren Buffett is 90 years old, live and kicking, going to office every day. His partner, Charlie Munger, is 97-year-old, live and kicking, going to office every day, even today. And then you look at the other noted investors on this page. All of them lived about 90 years on an average. So, working with startups makes you get younger, live longer as another additional benefit of being a happy life, right? So with that, I thought I'll leave you with some great treasure to read, learn and grow at your own pace. These are the books, some of the books that you can read to know far more, far deeper, and you will not need a lot of coaches to help you get started with your startup journey, investing journey, or helping journey for startups. So I'll pause here and then maybe go back to Sahil Makkar for the answers that came on the chat window.
So first answer is A option. Bill Gates we have given. One has given Jeff Bezos. One is Google. One is again a Bill Gates, and then one Jeff Bezos. So
Awesome.
total
So it is Jeff Bezos. It is Jeff Bezos of Amazon. Today, the richest man on earth. He had to have 60 meetings to raise his first $1 million for Amazon, and it's not too far ago, less than 30 years back, and today more than $1 trillion in market cap. First generation entrepreneur, still running the company very well. His parents, who did equity in his company, dollars into their son's company, right? So something about an open mind as to where the world is going, and with that, I know we have about. Sahil, your video is missing. Yeah, I can see you now.
So your voice was troubling in between. Can you repeat your last thing?
I'm saying you can move over to the question and answer, Sahil, now. Yeah. I'm happy to answer the question.
So thank you, Vinay, for your wonderful deliberation. So I'll take one by there are a few questions, so I'll take one by one. And I think we can. First question is, so much of the mentioned startups are yet to make any kind of operating profit. If they're losing so much of money, should they also be evaluated based on the viability of their business model? Or should they be subject to the usual free cash flow model valuations?
Sure. So the cardinal rule of valuation is a discounted cash flow. All of us understand it, right? Take the future cash flows, discount it by a interest rate or your weighted average cost of capital, do a net present value, and boom, there comes your valuation, right? So if I was giving you $5 and 2 hours, what will you value that $5 at? $5, not $650 that this guy's got. right? So the key is, what is the idea you are mixing? What is the hard work and the ability you are mixing to that money to be able to value. So the story behind the numbers is very important, right? And in the end, yes, it has to make money for sure. Only then the DCF will work. Let me give you an example. We treat startups like our own kids, right? First 20 years, kids don't earn. They have to be invested in their education. They have to be invested in their value system. They have to be sent to IIMs and IITs. They have to be smart about it. They have to learn very fast. But then they and their cash flow will start coming in plenty. That's what happens if we say my kid not taking up in MD college may cost you 1 crore. Or education in Harvard may cost you 1 crore, including the expenses, etc. Maybe why would you spend that education on that smart, bright kid? Because you know that in 5-7 years, when that kid gets to earn, you know, he will make money. Now, only those people who know about that kid are the ones who can invest behind it. If you were to invest behind your own son who is already topping in class, it's far more easier to invest. For you to invest behind my son, who you don't know, it's very difficult to invest behind that. For startups, once you are closer to, you know what he is trying to do, then you know in the future that I will make money. Traditional businesses and modern businesses, what is the difference? Both need investment. Ready land into building, into machinery. Cash flow was still negative. It just did not show up in the P&L. There is no building. There is no land. The real estate is the website. That's where things get sold. The IP is the machinery. The strength is your people, their knowledge, their hard work. Revenues and cash flows have to come. Then, in the amount of time, what is the right amount of time? For a small startup, let's say CA practice, you are covering a small area of work. It should turn profitable earlier. But if you want to cover the entire country, it will take time to build that business and make it profitable. If you're trying to cover the entire globe, profits will come later. Let's talk about it. Microsoft, why did it have to go public? Google, why did it have to go public? They have 80 to 90% margins. But when they were building that assets, when they needed the high quality people, when they needed those servers, when they needed those people building the code, and they needed money. They were burning money. And that's where they needed investors who believed in the vision and they knew that the kid will earn in the future. And that's when, once you understand those mechanics, you will know how the startup should be valued. For example, a Swiggy charges 30% on every food delivery from a restaurant. That's huge amount of money that Swiggy makes on that transaction. But it's expanding at a breakneck pace, which means it will need more people, more restaurants, newer cities, newer investments, newer senior leadership, etc., etc. That's where it needs to spend. Unfortunately, all of that spend shows up in P&L. And that's why we're not able to value well, right? So mindsets are changing, things are changing, and we need to look at things accordingly. Look at the gross margins closely. If a startup is making 40 to 60% gross, it is a great business. Just make sure that the fixed costs are in control, and after a certain point in time, you will be able to value them. But by the time they go IPO, and by the time we start valuing them on a price to earning ratio, times have changed. They will your wealth be. Hopefully that gives you a perspective around valuations, how to look at startups and how to look at the story.
Yeah, so point was like they were also focusing on operating profit. I think I'll add one point, like it's just not the operating profits or losses and all something. So investors also look for growth rate because scalability is important. So if the venture is achieving some growth rate in their revenues or numbers, I think that is also one of the criteria considered for investments and all. So next question is there any platform where we can get our idea validated?
Yes, there are a lot of platforms today. You can, for example, go to Punjab Angels and have these people look at you. Go to your friends and family and accountants and your business friends. Ask them what is wrong. Don't be emotionally so tight that if somebody points an error in your business idea that you take it to your heart. Use that to fix and improve your idea. There are platforms like many angel networks, and of course, Inflection Point Ventures is one of those leading ones, where you can go get your pitch validated, get feedback, get ideas, and even get how to improve your business. So, a lot of platforms available today to be able to get your ideas validated. But start from your family, start from your friends, start from your parents, start from your kids, start from your accountant, so they can some thoughts.
So, should I take next question? Yeah, I'm audible.
Was that clear, Sahil?
Yeah. So I'll take next question.
Yeah, we were not. Yeah.
Yeah. So I'll take next question. Next question is, how do you perceive valuations being skewed by excess cash made available to a startup, especially on sustaining such valuation? What is the role of a CA as an advisor in such situation?
Sure. Yeah, I think as a CA, you should advise the startup to take the money needed for next 2 years. Because pandemic can come at 2 years, then you're bankrupt, and the valuation is zero. As a CA, advise the worth of cash once you have crossed the POC stage. When there is cash excess, you will get higher valuations.
I think
In
your
today's
voice was
funding, you will get value. Yeah. So that's how, as a CA, always a difference between intrinsic value and price. Price is dependent upon demand and supply. Economics one-on-one. If there is money supply available, low demand, price will fall. If there is larger demand by startups, the price of money will go up, right? Valuations will fall. So that's how you should be looking at raising funding, amount of money to be raised, etc. Don't raise too much; you will end up diluting, and even the founders may become extravagant and not very vigilant in spending the money.
Yeah. So another question is like, how can an individual with limited resources invest in a startup?
Sure. So invest in a group. So if you want to invest only 1 lakh rupees, 2 lakh rupees, right? There are groups who will allow you to do that. Which means that today it is not only for the wealthy. It's not for those who want to put 10 lakh, 20 lakh, 30 lakhs into a startup. You can actually start with 1, 2, 3 lakhs also, right? If you have only 5 lakhs available in a year, invest in the 1 or 2 best startups that you can add value to. That's it, right? So invest with the group. You can pool the money. Invest with those who have a SEBI approved Angel AIF. There you could do a smaller amounts as well. So today, government is making these vehicles available for you to be able to invest smaller pools of money, even those who want to do 2, 3, 5 lakhs as well in a year.
So there's another question. What is the minimum investment amount for being part of any investment groups like IPV or Punjab Angels or anything to invest in startups and all?
So at IPV, it's zero. So you don't have to invest to become a part of the ecosystem and learn, right? Because we said there are 7, 8 ways you can engage with the startup community and learn and maybe earn, right? But if you are looking at a startup and investing, I think at IPV we want you to have a little bit meaningful amount, which is 2.5 lakhs, not much, but every platform.
Vinay, your voice is breaking. I think it's not audible. Hello? 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 I'm audible?
In between it went away.
Yeah, so I think maybe it's net connection at your end or my end. You were not audible, to me at least.
Sorry, should I repeat?
Yeah. I think you should repeat his last few lines.
Sure. So you can invest in groups. So if 2 or 3 friends come together, 3 of you can together do a 2.5 lakh entry, right? So you can still do a 80, 90, 1 lakh kind of an investment in a startup. And you can invest with accordingly also like that.
So there is another similar question. I would say you have already replied. How do you invest in a startup as an individual on a level? Is there a fund or a product? Also, how to contact or set up business relationship with a startup?
Yes, I mean, if you're a part of these groups, then startups anyway approach these groups. And therefore, if you're investing, you will have access to the founder and the business. You can even, take a advisory position or help the startups and the founders think through their business model or help them give connections, tell them about Companies Act, help them do accounting, and so on and so forth. So a lot of venues available. Join any of the groups. Join Punjab Angels or join IPV, doesn't matter.
So there's another question. For how long do you think that VC market can give 26% kind of IRR? Hello, I'm audible. Hello.
I'll Sahil. No, I can hear you now, Sahil.
Yeah. So question is, for how long do you think that VC market can give 26% kind of IRR?
So I think most VCs and private equities do generate about 20% IRR. And people who do it well will generate 20 to 30% IRR easily. Even at IPV, our average IRR for last year, it's just a number, was more than 100%. We will not generate it again because sometimes these are, incredible times. But most PE and VC firms generate 20% plus IRR.
So there's another question which says, should we invest in IPO, which is lost prior to a IPO?
It's my personal view, so don't want to color anybody. By the time a startup reaches an IPO stage, I think it is overvalued usually. But then, of course, there are still some good gems who make it there. But I would be very cautious in putting a retail money into IPO because a good IPO will have a lot of oversubscription. And the allocation may be very less. A bad IPO, you will get a higher allocation. So what's the point in getting a higher allocation of a bad IPO and good IPO you don't even get? So it's a bad thing both ways, and it's anyway overpriced sometimes. So one has to make that judgment very closely whether one should do it in an IPO or not.
Another question is how to calculate intrinsic value of any company.
Intrinsic value is very simple. What is the value of discounted cash flows that a company will generate over the X number of years, discounted back to the present by using a weighted average cost of capital? That is the intrinsic value of the company. But you will never be able to buy a company at intrinsic value. Either it will be overpriced because of the lot of heat and the investor money chasing it, or you will be able to buy significantly cheaper than intrinsic value because it's a boring sector, right? But that is the place to be. Buy a company lower than intrinsic value in a boring sector, nobody else is chasing, have the conviction, and then once it turns out that it's a great company and it starts getting chased, that's when it's a good time to sell.
Another question is like, is there a credible platform available online where various startups available for investment are presented and people can decide and invest in them?
Yes, there are about 5 to 6 good platforms available in the country. Other than, of course, Inflection Point Ventures, you have Indian Angel Network, you have Mumbai Angels, you have Punjab Angels, you have Venture Catalysts, you have Let's Venture, you have Angel List. So about 7-10 good groups are there in the country. You can join any of these.
So the thing is like, if you become member of these platforms and also you can weekly or monthly and all, their presentation of startups and people can actually then invest after listening to their presentations and asking as many as questions you want on a common platform.
Absolutely.
So there's another question like, can you provide some statistics about number of startups who have taken exit?
Sure. I'm guessing you're talking about IPV. So at IPV, which is kind of close to my experience, I had invested, let's say, till about December of 2020, about 45. Out of 45, about 8 have been exited, which is about 20%. And another 15 have taken the next round of funding at a 2x or 3x, right? So about 23 out of 45 in the last 1 year have already made significant returns. Others, out of other 22, maybe one would have shut down, one would have returned the capital. So that is the kind of ratio that we saw here. But generally, any startup starting, 100 starting, 90 will fail generally if they are not doing good due diligence, if they're not investing in groups, if they are not looking at the business model correctly, if they're not looking at the founder team correctly, then 90-95% will shut down. But if you do these things right, then you have a very good shot at doing half of them right. And those half will be 5x, 10x. And therefore will pay you far more, as you saw in Peter Thiel's example or a few other examples.
So there's another question like, pandemic gave the food tech companies like Swiggy, Zomato, Uber Eats, etc. a lifeline to make a turnaround in their financials. Despite many-fold revenue increase, they are still making heavy losses. In fact, all the food tech companies around the globe are yet to make any profit. Is there any way for them to become profitable?
Yes, I think most of these will become profitable. Uber Eats is already profitable, right? The issue was faced by these companies also, whether it is Zomato or Swiggy, because initially 2-3 months of lockdown, there was no movement, right? No movement allowed. All restaurants shut down. So of course they also were hit very, very badly, right? But food is a very high frequency item and it's a 30-40% margin, right? And therefore the ability to make money on food is heavy and high. And we believe that if the businesses are run right in a disciplined manner, the businesses will get profitable.
The question followed for this is, or if the IPO is the only target, and if the IPO is the only target, should retail investors stay away?
Yeah, I would say IPO generally retail investors should stay away. That's my personal view. So not taking away anything, and I have the right to be wrong, and I reserve that right. But yeah, see, IPOs generally happen because the existing private equity investors have to also take an exit, right? They have helped the company get that far, and they also have to pay the money back to their LPs. So a lot of these guys take exits over a period of time, but after having built a good company, right? But IPOs, I am personally not a big fan of investing during IPO. I'll rather invest in Zomato in 2010, or maybe 10 Zomatos in 2010.
But don't you think the ultimate goal of a startup is to actually launch, to have an IPO only, so that they can give an easy exit to their investors and all? Otherwise, Series A and B, C, D are investing in, but ultimately they are also looking for profits, and profit is ultimately made when they are actually launching their IPOs.
No. I don't think the ultimate goal of a startup is to have an IPO. the ultimate goal of Apple is to make great products for its consumers and to innovate. IPO happens or not, IPO is one milestone in the journey, right? The main goal of humankind is not to just get married, right? It's to do something meaningful on this earth. The main goal of Microsoft is to build great products that can improve your productivity every day, right? It's not to have an IPO. So IPO is a very minuscule, small, early stage step in the life of a startup, right? Many of these companies, even after IPO, will not succeed. So the main goal is the mission and the purpose that the business exists and that it should continue to do over a period of time.
So there's another question. Is there a way to sell your investments and make an exit before an IPO? What are some of the exit gates other than an IPO you can suggest?
Yes, most of the angel investors exit far before the IPO because future rounds keep happening. You know, a person like Sequoia will come in and invest. A person like Tiger will come in and invest. Other angel investors will come. So money rotates that way. So angel investors will take an exit at a series B. Let's say they make their 5x, 10x and they move on, right? So that happens. So IPO is not to be waited till. Very few angel investors will wait till IPO actually.
So next question is, what is the approximate percentage of success rate of startups?
About 5 to 10% generally. Organized groups 10 to 20%. Places like deep due diligence, let's say IPV, etc., will be anywhere 20 to 60%. Private equities 60 to 70%, or even 80%.
So do you think investors invest into the companies of founders where the founder is actually involved in multiple startups?
Sorry, I missed your question, Sahil. Do you think the investors invest in companies
Investors,
that?
a company where the founder is involved in multiple startups?
Typically not. Typically not. And I think if a founder is involved in multiple startups, he should not take money outside because investors want their money to be focused, right? A founder has the choice to do multiple startups, but then he should be able to run his business on his own. Typically, the term sheets will carry an exclusivity clause for the founder to run only one business where he or she is taking hard-earned money of the investors and therefore should be giving its full soul, time, and effort and energy in making that startup succeed.
So there are few startups who believe like just to get in the cash flow coming in. So along with their startup, they should like make a website and all, open up their small companies and all, so that cash flow comes in on regular basis. Maybe within that same company only, which they're looking for funding and all. So is the right way to approach that?
There's no right or wrong way here, Sahil, but let's say you want to do a startup and it will take only half a day of yours. You are a professional chartered accountant, you can, give services to others, or, you can help others do other stuff, not practice. Then you can do that for your side income and invest that into the startup, right? And take it to a POC stage, build a good product, and, it's now ready to scale. But when you're ready to scale and you want external money, at that point in time, you should stop that side business and focus. Because now investors are giving you the money to scale and to, get your salary, etc. At that point in time, you should respect the money of the investors. Before that, when you've not picked the money, you are open to do 10 businesses if you want.
Okay. So, do you believe there are it's good to have co-founders, team of co-founders?
Yes, I believe it's co-founders. Nobody is a Superman, and if we try to do everything, even the brightest cannot. And 2 to 3 co-founders usually form a very good team. But get the co-founders who complement your skills. not your clones. Right? So if you're a chartered accountant, get a business guy, get a technology guy, right? Get a sales guy together, so you can run various parts of the business very well.
So do you believe like matlab co-founders with the same knowledge base or technical knowledge should be co-founders, like three from technical background and or maybe two from financial background, both CAs and all? Is it a right combination according to you?
I mean, any combination can be right, but the success rate of both the founders coming from only the same background, right, is low generally in a new tech area, but it can be high. Let's say if you're starting a CA firm, right, then you need only 5 CAs to run that firm, right? That is also a startup when you go into your practice, right? But there 5 CAs will work. But if you are a company trying to get into food tech, a CA, then you will need somebody to run your technology. You will need somebody to run your operations. You will need somebody to run your factory, somebody to run your restaurant. You need a chef to make the food. You can't do it all, right? So it depends upon what kind of a business you are getting in. And typically, if you are, disrupting a market, you're bringing in new technology from multiple arenas together, you will need those experts to be with you to be able to solve problems at larger scale.
So I think CAs can play a very larger role in the startups and all, because their compliance, their financial things becomes a major part of it. I always believe finance is a blood of an for an organization. So the
Even
blood flows,
fundraising,
everything goes on.
not just compliances, accounting, taxation. They need funding, and CAs understand funding. CA understand valuation, so they can actually work with private equity, VC firms to get them the right valuation, the funding, the valuation certificates. So a lot can be done.
So few questions have come up. More questions have come up now. So I'll take another 2-3 questions. So could you recommend some examples about some good startup which are coming up and available for investment at present? If yes, then to invest with which platforms?
Well, I think this may not be the right forum to capture those, but I generally say that, invest with your friends and family, which means if you have a bright son, he wants to do something new, give him some money to try his idea. Jeff Bezos' parents are billionaires because they gave him that money, right? And you know your son well, his, or your daughter well, you know their strengths, you know their weaknesses, you know the strength of their idea, and only you know it. Your friends don't, right? So be an early investor in those ideas which are closer to you and you believe in. Work with people you like, trust, and admire. That is usually a good way to get successful, right? But if you want to look at other outer startups, just log into Inflection Point Ventures, for example, or download our app. Everything is on. It's do it yourself. You will see hundreds of startups, that you can evaluate.
So there's another question. What would be the trigger to exit other than for booking profits?
Booking profits should never be the trigger to exit. The trigger to exit is what you believe from your conviction when you were wanting to invest. For example, if you invested in a company because it was doing great food and it continues to do great food, right? Only when the founder has got to quality, you should exit. Exit bases your hypothesis and your conviction in the business, or when something changes in the business, not just because you want to book profit. If you book profit early, then you may lose a tenet of the profit that was to come later, right? Because as businesses grow, the risk reduces, not increases. So think about that as a criteria, because people could have exited in Apple early on. People could have exited Amazon early on, but those who have the belief and the conviction in the idea and the business will stay longer and will make the thousands of X of return that Peter Thiel made in Facebook, or Elon Musk and the others are making in other places.
I think someone's mic is on. Can you please switch off? I think Narshing Das Gupta. Yeah. So next question is, with some sectors in the startup ecosystem being heavily competitive, like travel tech, food tech, fintech, will consolidation help them becoming profitable?
Typically, it does, right? That's how the world works. So first, you have various ideas, then you get either merge into a larger company, or you consolidate, which means you collaborate, and therefore you fix a lot of things. And then in the end, either a oligopoly or a duopoly or a monopoly emerges, right? That's how the world works. Unfortunately, that's the way the world is. But if you are highly innovative and you're doing something great, you will have huge opportunity to grow. That's how Apple grew. That's how Microsoft grew. That's how Starbucks grew. That's how Flipkart grew. That's how Ola grew, because they did something very, very different with the new technology that the existing businesses did not. And they took the scale very fast. And that's why it's important to get scale fast in companies so that you can stay on your own without being impacted by takeovers or consolidation.
So, so there are few compliments also mentioned. I'll read few of them. Very good insights, well compiled and insightful presentation and lecture. And there's another one which says, this is clearly one of the best ICAI sessions I've ever attended. Congratulations to Bhiwani branch. Congratulations to Janjot sir, Sandeep sir, Raghu sir. Big thanks to Vinayji. Last but not the least, a big thanks to Sahil for being a super moderator and all. So there are few compliments for these things and all. So I think,
Thanks for
and
having me.
yeah, and I would say one key takeaway, I think, which audience or people should take away, believing if they are into investments or they want to become a startup, is from your presentation, is that 70 to 80% failure is actually only on two bases. If we can improve on those two bases, I think every startup can. And those two you mentioned were business quality and founding team. So if people can focus on their business quality, like quality of their products and things and all, and focus on their founding team, then I believe investment is not a problem for anyone.
Absolutely. It's like your kids, right? You teach them well, send them to the right school, send them to the right college, they will succeed. But still only 1 to 2% of the kids really succeed that well.
So I think thank you very much for this wonderful deliberation, and I believe the question answer round also went well, and we were able to answer many of the questions and to the audience and all. And obviously, and people, if they are interested, can contact Vinay sir directly or anything and all. So
Absolutely.
moving ahead, I would now request C. Nand Kishore ji Hegde ji, Vice Chairman, Committee on Management Accounting, for his concluding remarks. Yeah, Mr. C. Nand Kishore ji, are you available?
He is not here, sir. You may proceed further.
So I think next is I would request CA ND Gupta ji, Vice Chairman, Bhiwani branch of NIRC for his vote of thanks.
Very good evening to everyone. I, CA ND Gupta, Vice Chairman, Bhiwani branch of NIRC of ICAI, feel it my great pleasures and privileges to give me the opportunity to thanks on behalf of my own and on behalf of the branch at this special occasion. I thank CA Charanjot Singh Ji Nanda Ji, Central Council Member and Chairman, CMA, for his keynote address, who, despite his busy schedules, spare his valuable time to grace the occasion by his presence. My heartfelt thanks to CA K. Raghu Ji, Past President of ICAI, for special address, who have blessed us with his presence. We are grateful to CA Vinay Bansal Ji, eminent speaker, for his word of encouragement on the topic. I thank for his kindness, interest and continued support to us on the deliberation and reply on the questions raised by the participants. I would also like to thank Vice Chairman C. Nand Kishore, C. Hegde ji. For concluding remarks, I have our chairman, C. Sandeep Jangra ji, his team, and members of the branch to grace the occasion. I would also like to thank our organizers, CMA committee, ICAI, to organize the webinar by inviting the Bhiwani branch. Last but not least, I thank all of the participants for showing interest in the program and making it successful. Thank you, sir. Thank you.
Thank you, sir.
So thank you very much, everyone. See you in next session.
Thanks, Sahil. Thank you, Nandaji. Thank you, Raghu sir. Appreciate your time and thanks for having me here.
Thank you, Vinay sir. Thank you, Sahil ji.
Thank you, sir. Thank you very much. Thank you, Makkar ji.
Thank you, sir.
Thank you, sir.
Yeah.
Thank you very much.
Good night, everyone. Have a nice time.